So we got a couple of things to cover. I think it's probably at top of everybody's mind right now that chat disabled. Okay, fine. Enter the questions in the Q&A box. I guess somehow chat got disabled. So yeah, enter questions in the Q&A. That'll work just fine. So a couple of things to cover. I think this is probably top of everyone's mind right now, but recession and economic cycle. What the Fed is doing seems to be a standing topic of all of these meetings. Really, wow. I mean, probably for the past 5-6 years, it feels like we've been talking about the Fed time. We're gonna try to dig a little bit deeper, on some of the things that are being covered, in the headlines, and try to make some sense of all those, all the different things that are out there today, and then some silver linings and kind of what we see moving forward, for the market. So we'll jump right into it. So few investment themes for 2022, and really themes that we sort of see, continuing to be pervasive, throughout the next 12 to 18 months. The first one, actually, it's interesting because probably the most notable investment theme is not even listed here, which is that stocks have entered a bear market and have stayed in a bear market for, I don't know what, Rick, the better part of half of this year now. We've been down into the negative 20% range.
I would say almost 3/4.
Yeah. So and it's interesting because it's honestly not even the most interesting theme that we're seeing right now. It's really these three pieces. Volatility, most volatile market since 2008, 87% of trading days, 1% swing or greater, one way or another. I think we've had a 1% swing or greater like every day for the last 2 weeks, which is crazy. This is the worst, by most accounts, bond market ever. So, a bear market is fairly commonplace, but a bond market that's moving in unison with the stock market on the way down is, even in 2008, that was not the case. The bonds were your ballast in 2008, and in 2022, bonds are almost down as much as stocks, which is
down bad. The aggregate's down about 15% right now, so
there's nowhere to hide.
Yep.
And then inflation, another thing that we've been talking about ad nauseum. Actually, it has sort of been leveled off. The top line figure of 9.1% on the CPI peaked in June. By the way, lock in your I bonds today because the rates. Was it tomorrow? We were just talking about this.
No, tomorrow's the last day. Yeah,
tomorrow's the last. Okay, lock them in tomorrow.
Lock them into there tomorrow. The website is running extraordinarily slow.
Yeah. So that peaked at 9.1% in June. I think that backed off to 8.2%, somewhere in the 8s, last month. But the sticky inflation factor actually rose to a new high, which we'll talk a little bit more about. But the sticky inflation is why we see this continuing to be a pervasive theme.
Let me jump back on that volatility for 1 second, Dan.
Yeah, sure.
And how they define volatility now. If you look at the VIX, the VIX, that's the symbol. You can see that volatility in the VIX, and when it runs above 30, you have a lot of volatility in this market. When it starts coming down into the 20s and below 20, that volatility is going to settle down. So you can literally watch that volatility go up and down. One piece of interesting news is we keep talking about capitulation. And everybody wants to know if capitulation is there. JP Morgan had mentioned capitulation, things like that. Capitulation is usually clear when the VIX skyrockets into the high 40s and 50s. Once you see that go into the high 40s and 50s, typically you'll see capitulation behind that. So just an interesting piece of information on volatility.
Yeah. Yeah. And I don't know if we've quite reached that yet, although Bank of America thought we did.
They did think we did, and they still think now they say we're going to.
Yeah.
Not yet.
So I think that one of the major factors here is obviously there's been a ton of headlines around recession, you know, and are we in a recession? Is there a recession coming? You know, Biden says there's not a recession coming. Jay Powell says there is a recession coming. So there's I think there's a lot of noise out there. And, you know, one of the things that I know that I've had it, and I know, you know, Rick has as well. Like, what are we really talking about, right? When we talk about recession. So, you know, there's a lot of different definitions. I think one of the pieces is, you know, I talk about bear market, which the technical definition is a 20% correction in the S&P 500. And I think a lot of times that gets sort of mixed together with the recession. So, you know, one of the things we'll talk about is, you know, economy is not the stock market, obviously. They're the different animals. You know, but the other piece is that tends to get thrown around is sort of a simplified version of recession is you know, 2 negative quarters of GDP in a row. Which we did have, and actually now, you know, we just had the GDP numbers today that surprised on the upside. The economy grew 2.6% last quarter. And I think that it may be helpful to sort of clarify for folks, you know, what really how a recession is defined officially. And technically that's by the National Bureau of Economic Research.
Before you dive into that, Dan, there's two more definitions I just recently heard of that people are hearing out there. One of those definitions is actually the very short end of the yield curve, which I believe it was the 9-month Treasury bill is now higher than the 10-year as well. And so that is another definition, so they say, of a being in a recession. And we'll talk a little bit more about the yield curve as we move forward. But the very short end of the yield curve is what they're talking about as being another recession. And an interesting one that I read the other day, which is here on my computer, it says in basic terms, a recession is when the economy's performance decreases for an extended period of time, typically 7 months. And we've seen a lot shorter and a lot longer than that, marked by the GDP contraction, higher unemployment rates, and lower consumption and spending, consumer spending. And then during a recession, many people experience significant impacts on their daily lives. I wouldn't say many people do, but there's a lot of people that do as this labor market shifts. So I just wanted to say that because that's the typical impact that people actually feel is layoffs. And I don't think we're going to dive into the depths of the layoffs, but we'll talk a little bit more about that as we get through some of these slides as well. So go ahead and talk about this heat map, because this is interesting.
Well, I think that's important because it is, you know, a pervasive topic in the news. And I think that, you know, you got a lot of reporters just looking for looking for the data point that's going to be compelling, right? So we're going to hear recession defined in a lot of different ways, I think, you know, over the next 12 months. But technically speaking, a recession is defined by the National Bureau of Economic Research. And it's not surprisingly, I suppose, somewhat subjective, which I suppose is why there are so many different definitions. But these are the variables. There are 6 main variables used by the Bureau in determining a recession. And the reason I say it's subjective is, and Rick and I, we were talking about this before. The reason we say it's subjective is not all of these have to be negative for the Bureau to determine that we are in or were in a recession, which is an important distinction. As you can see, so in 2020, I'm gonna try to kind of draw a little box here. So 2 months during 2020, March and April, which was during the onset of COVID, all of these figures were red, and there was a determination that we were in a recession. And it was, all of these flashed red for 2 consecutive months, and that was the determination. This is a recession. That was a pretty cut and dry one, but it was also a fairly quick one because, as you can see, it then turned green across the board for several months thereafter. If you remember 2008, it was not quite as pretty. So the interesting thing here, though, is to see that, we've had some red flashing, over the last year, especially in these real consumer spending and real wholesale retail sales, the keyword being real, that means inflation adjusted. But most of the other parts of the economy are fairly healthy. And there's a couple pieces here to be aware of. A healthy economy and a economic research bureau that's essentially, sort of writing the script for a lot of economic outlooks and forecasts, that is essentially showing, we don't have an we don't look like we're in a recession. It's very likely that by the time we actually get to a recession, they're only going to define it once we get out of it, or once we're already in it.
So what did you call that? Posthumously?
Yeah. So in other words, like they use lagging data. So like, they're going to say once the recession's over, like, yup, that was a recession, or no, that actually wasn't a recession. And I don't know how helpful that is, but technically speaking, this is how recessions are determined, is because, these are the cyclical parts of the economy that they're looking at. Rick was talking about the inverted yield curve, and which is more of an indicator, right? So inverted yield curve, essentially, you get paid more for a 2-year bond or a 1-year bond than a 10-year bond.
Yeah,
right?
so
That's
typical
essentially an inverted yield curve.
Yeah, typical the what defines a recession is coming is the inverted yield curve. Is the 2-year bond is higher than the 10-year bond. And that stays, if you look at 2003 all the way through 2006, actually, I guess it really started around 2005. You'll see an inverted yield curve from 2005 all the way through 2006. And that's the 2 and the 10-year.
Yeah, we've been there for what, 6 months or so?
June 15th, we hit it the first time, and it's been there since June 15th.
4 months, yeah.
So we can be in this position for a while. Where we're
and again, so this average months till recession from the inversion, 14.5. We're 4 months in. And the interesting thing with these indicators are obviously, these are not perfect. And as you can see, unemployment and housing starts, we have not met the threshold, meaning unemployment is not rising and housing starts are not declining. Consumer confidence has declined. We've met that threshold. But technically, most of the underpinning parts of the economy still look pretty good, even though we still have these recession indicators, such as the yield curve. And then just a little bit of perspective, I would say, before we sort of dive into what's going on behind the scenes and why, this is something that's important to think about. Recessions do not last, on average, nearly as long as expansions. I think that, and a lot of investors' rear view mirrors is 2008, because that's kind of the most recent actual cyclical downturn. COVID was sort of a blip. And the last cyclical downturn from a average perspective was much more severe. On average, recessions last less than a year. And again, economy is not the market. This doesn't mean that the market is down 2.5%. That means GDP contracts 2.5% during recessions. But the point is, expansions are larger, much more powerful, and typically much longer than recessions. So they're typically blips in a longer term, from a longer term perspective. This recession may be a little different. So I can't take credit for this one. And I don't know if everyone can see the title of that slide. It's called, it says the recession that didn't bark. This was an analogy, a metaphor used by a JP Morgan economist that without going into it, essentially he compared this recession to a Sherlock Holmes novel where a guard dog doesn't bark when a racehorse disappears in the middle of the night. And the point of the story was he thought it was peculiar that the guard dog didn't bark, right? And the point here is that typically in a recession, the Federal Reserve, central bankers, government officials, whether it's fiscal or monetary policy, they will respond during a recession, right? You think 2008, which we'll talk about a little bit more what happened during 2008, what the response was. But you think about it, unemployment typically is rising, GDP is typically contracting, so you have policy response to try to stifle growth. In this case, you're seeing a hawkish Federal Reserve increasing rates, letting capital flow out of the markets. This is more likely to be a policy-induced recession rather than one that occurs because of a cyclical downturn and you have a policy response. This one is likely to be quite the opposite, where there is no response. The Fed is going to just continue on its aggressive path. Again, kind of similar, we've talked about in past, kind of similar to the 1980s. The difference here, without having that policy response, there may not be much of a catalyst for a snapback, kind of like COVID, where you had that big drawdown, and then all of a sudden you had the market shoot back up. And again, similar to the 80s, what we see is probably a longer road ahead, slower growth, persistent inflation. Although we don't think it's going to stay at 8%. It's certainly not going to go back to zero where it was for the last 10 years.
When you say policy response, give us some indicators, or what are some of the policy responses that we've seen in the past?
So policy responses would be things like reducing interest rates, quantitative easing.
In a recessionary environment.
Right. In a recessionary environment, correct. Tax breaks, that would be fiscal policy, right?
Deferred RMDs.
Yeah, fiscal policy, right. That's no. So, anything you could think of that would put more money into either consumers' pockets, businesses' pockets, things like that. Whereas in this case, we're looking at policy induced, meaning, as you can see, right, we got this going on. We got rates going zoop, all the way up. We just have a steep increase in interest rates. Now, the interesting thing here is you can see this is a little hard to see. This kind of box off to the right is what the Federal Reserve expectations versus the market expectations. And, we've been talking about this a lot, but the market is kind of priced in a recession, meaning the market is already expecting the Fed to continue on its rate increase cycle. And again, in the same theme of the market is not the economy. If we have a mild recession next year, it's very likely the market will just be flat, because the correction that we've experienced in 2022 is in anticipation of a 2023. Right. So these rate hikes are kind of already built into the market. The other piece that's happening in conjunction with, and Rick and I always talk about this, but what's happening in conjunction with the rate hikes is the other piece of contractionary policy, which is the Fed is starting to let their balance sheet quote unquote roll off. So the way that the Federal Reserve injects capital into the markets is they do one of two things. They will either lower interest rates, or they will buy treasuries on the open market. And what that does is essentially they put a treasury on their balance sheet, and then there's just capital available. What you're seeing on this slide is during 2008, November 25th, 2008, they announced they were going to start introducing capital into the market in an effort to help soften the blow of the recession. It took them until the end of 2014 to terminate that program. They did it in 3 different waves, and over that time, they added, if you add up these pieces, what's that, $3.5 trillion to their balance sheet. So that's how much money they injected into the markets. And I think it was I remember because it was the week of Christmas. They started to roll,
right?
Yeah, they started to roll that off. You see right here. And the market reacted pretty harshly. There was like a 20% correction in 3 months, just because the capital started getting sucked out, and it bottomed out, and the market, once it kind of got used to that, it's sort of.
So take that back for a second. Hold on a second. So in 2018, that wasn't really a 20% correction, because that would have defined the end of a bull market. And the end of the bull market wasn't actually defined until February of 2020. So
it was
that
like
market
it was like 19.5%. Yeah,
19.8% was the downside, and they were trying to define that as the end of the bull market. So, but it really wasn't. And then when you look at this particular, I don't know if you were going to go into this, Dan, but when you look at the S&P 500 laid over top of this, the S&P 500 grew from 2009 all the way up to 2020. And even though they started to unload the balance sheet in 2018, right around the last quarter of 2018, the market reacted downward to that, but all of a sudden just took off back up because of, I guess, of the potential anticipation. I don't know what it was, but the bottom line is the interesting part is the market actually followed the growth of this balance sheet. So you look to the other side of that dotted line, and we're not there yet. But you might see some tracking to that downward slope in the S&P 500.
Yeah, and we'll see. I mean, the question is, how much is the market pricing in of this? Right. I think I read a statistic that there's been like a 90% correlation between the stock market and the Fed's balance sheet since 2008. And you could see that with COVID, and this, I think the policy error has already happened, and they're having to walk it back, because there were 2 years since COVID, and a lot of it happened right at the onset, but they created more liquidity during COVID than they did for 2008. And 2008 was a structural bank problem, right? Let's make no mistake, a 30-day shutdown was nowhere near the structural bank problem of the subprime mortgage crisis. And I think the issue here is that they've now created this mountain of money that's why there's inflation. I mean, that's the long and the short of it. And now they have to undo what they did.
The injection of money in 2008 and 9 was more specific to keeping the circulation of money out there.
Right.
Just keeping the circle flowing. And Ben Bernanke's thesis that he actually just won a Nobel Prize for, in his doctoral thesis, talked more specifically about what happened in the crash. And what happened in the crash in 29 is why we ended up in a long-term deflationary environment, is because the circulation of money stopped. And once that circulation of money stops, then all of a sudden you run into a deflationary period. And this is why, he had They called him Helicopter Ben back then, but he had injected money into the system. Not a lot in comparison to what we did in COVID, but it was enough to keep money in circulation.
Right. Right. So, I mean, this is sort of really what's going on behind the scenes. I think why you're seeing inflation, why you're seeing aggressive rate hikes, why you're seeing markets kind of correcting back to the air's coming out of the balloon, so to speak.
Yeah. And why we didn't see that from 2009 to 2020.
Yeah, right.
Because we didn't have that level of injection of money.
Right. So just to pivot a little more towards the inflation question here and kind of what's going on, because we were hearing how the word was transitory, how inflation is transitory for a long time, and it was transitory. When it was 5%, it was transitory. When it was 6%, it was transitory. When it was 7%, it hit 8%, it hit 9%, and somewhere along the way, somebody who was paying attention said, "Oh, wait, this is actually a problem. We got to do something about this." So, the Fed has been aggressively hiking rates. We saw, I think just today, I saw come across that mortgage rates have topped 7%. 30-year mortgage rates have gone over 7% for the first time since pre-2008, since I think it was 2006 was the last time they were that high. And the housing component of the CPI is a really important piece for what's happening with inflation right now. And it's kind of, there's a little bit of a disconnect actually, and could potentially cause the Fed to overcorrect, as they're trying to unwind what they did. So we talked about sticky inflation and we talked about headline inflation. So I said, sticky inflation rose to its highest level. So sticky inflation removes the volatile pieces, food and energy. Right. So we've all seen gas increasing, natural gas increasing, food prices, grocery store bills going up. The sticky inflation removes those components. So, one of the major concerns is, well, okay, we're starting to see headline inflation turn, even though it's elevated, it's starting to turn. So that's good. Maybe the Fed will start to back off a little bit, but sticky inflation is still increasing. So they're not really, they still have another 1 to 1.5% of rate hikes they're going to do, which would, again, that suggests mortgage rates are going to get up to over 8% before all is said and done. So one of the pieces of inflation, and a large piece of it, a third of it is housing, which is also part of that kind of sticky inflation measure. And the CPI, as far as housing data goes, is using lagging data, meaning it's using real numbers from the last 12 months, right? So think about, and it's using homeowners, renters, kind of the whole, anything in the housing market. So think about somebody who locked in a lease in February 2022, right? Locked in a 1-year lease. So that's still in the number.
So they call that owner's equivalent rent. And I think that's a lot what we're hearing on the news. So define owner's equivalent rent in a little bit more detail.
Yeah, so that's the other piece. So 1-year lease that was locked in February is part of the number. Owner's equivalent rent is, so you take like the price of a house, take mortgage rates, and then do like a typical mortgage payment, right? You figure you got escrow for property taxes and homeowners insurance, you got your principal, you got your interest, and they come up with a figure that basically says, so for homeowners, this is they do an equivalency calculation where based on what they're paying, they put that number in with leases, right? So essentially think about your mortgage payment, and they take that as an equivalency for a 1-year lease, and they bake that into the housing index, housing component of the index. So as you might imagine, right, like when house prices are up, that means that's going to be more expensive to pay your mortgage, and therefore the equivalent rent is also more expensive.
So if I'm paying a rent of $4,200 a month, and the equivalent to that for the owner will be somewhere around $36,000 to $40,000 a year in
Right.
costs.
Yeah.
So it would cost the owner that much money to own the house, to pay pay the taxes, pay the utilities, pay services and things like that.
Right. So you have kind of two pieces working there that are if you think about it, it's interesting because when rates go up, that's supposed to head off CPI, but when rates go up, it makes it more expensive to own a house. So that part of the CPI actually will increase as a result of rates going up. But one of the things we're seeing is that in like private data, so companies like Zillow, platforms like that have more real-time data, that some of the home prices in some of the markets that have, that had those giant leaps during COVID, they were up 20-30% in home prices. Those are starting to precipitously drop off. Rents are starting to drop off as well, but that's not being reflected in the CPI yet. So like the Fed is working off of old data, and they're saying we got to keep increasing rates, and the real-time markets are actually starting to correct, but the Fed isn't seeing it in the metric that they're using.
And that's the important piece to understand is that rents have actually slowed down. I don't know if they've gone down, but they've slowed down in their growth. So they basically peaked about 6-7 months ago.
Right. They've peaked, but inflation is a year-over-year metric. So it's looking at increases, and it still looks like housing is more expensive. And it's likely to take longer for that to permeate into the core CPI number. So it's very likely that the Fed, even if they just stick to their current rate hike schedule, will end up overcorrecting. Yeah.
And so
let me go back. I missed the slide there.
I'm not sure if you covered that other piece too, as for housing prices. As housing prices continue to go up, I mean, we really got into a point where the COVID had accelerated housing prices pretty aggressively for two reasons. One, there was a lot of money pushed out on the street. Two, you had COVID and people wanted to get out of the cities. So a lot of the people living in the cities bought out in the suburbs, bought out in other areas because they could. So that really pushed housing prices up. Plus, housing prices, we were at a dead stop for almost 2.5-3 months. And then more people came into the market. We're still about 4,000 or 40,000 houses short of something like that of housing.
Oh yeah, inventory. Yeah.
Inventory is still
inventories
short.
are way down.
Yeah. So, but housing prices going up like that, once you buy into the house, then you automatically have to increase rents. So so your owner's equivalent rent goes up, and your actual rent will have to go up if you're buying a house to rent it out. So that's how that tends to follow suit as housing prices go up.
And I think that this is the other major piece, is that if you draw a line here, this is an index, housing affordability, going back to the 80s. This is, pretty much within the last 40 years, there have only been 2 other times that in aggregate, housing has been, this is again, rent, purchase, just housing affordability in general, have been this unaffordable, right? The only time it's been worse was in the early 80s, when you have you had those double digit, 14-15% mortgage rates. So the lower on the scale it is, the less affordable. The higher on the scale, the more affordable. So you kind of look up here coming out of the recession, it was, values were depressed, much more affordable. You look even over here, right? So rates are super low, much more affordable because it's easy to get capital. Now we've gone completely the other direction. And this is more likely to achieve what the Fed wants, because the one thing that's keeping it up, as I was kind of reviewing, is the shelter component, housing of the CPI is the one thing keeping inflation elevated. This would suggest that what they're doing is working, and we should see inflation come down. Now, it may take 12 months, and we may see a mild recession as part of their kind of crusade against this, but this is fairly likely to tell us that inflation is going to come down. I think the other piece to that whole picture is the labor market right now. There was kind of a major shakeup, I would say, in the labor market with the COVID infusion of capital and what it did to the markets. You had a lot of early retirees and a lot of, I think there was early retirees and stay-at-home moms. So people who otherwise exited the labor force. And what it did is created such a tight labor market that, unemployment is way below trend and wage growth is way, way above trend. And
what do they call that? What do they call that in the news is the participation rate?
Right. Yeah. Yeah. And typically, like historically, really, over the last 40 plus years, typically these things are in a constant push and pull, right? Like you see every time unemployment comes down, wage growth comes up, and they kind of like bounce off of each other, right? So usually you don't have them sort of inflect where all of a sudden you have super low unemployment and super high wage growth. And that's where we are right now. It's where we've been sort of since COVID, that we've been in this sort of inflection point where both are sort of tightening the labor market. The only time it's happened before really is it happened in the 70s multiple times, as you can see here.
Yeah, and every time that happens, that's when you see inflation.
Right, exactly. And the Fed won't say it because the Fed's mandate is supposedly full employment, or at least a healthy labor market. But I personally think the Fed wants unemployment to go up. I think the Fed the Fed would be happy to see that happening.
So the definition of full employment, according to the Federal Reserve, is actually 4%. So sure, you can see that, yeah, right? That blue line right there, about 4%. Once the Federal Reserve gets to that, they'll start slowing down. Between that and in addition to wage growth. So wage growth is another important piece to that puzzle. So if they get above that 4% and they still have wage growth, then we still might have an issue with inflation, because that tends to be a vicious circle. The more you have inflation, the more the wage continues to grow, and that also can come by in supply shocks, which happened in the 70s, in the early 70s and throughout the 70s actually. So which Dan will talk about a little bit further up. But anyway, I just wanted to kind of identify that 4% is really what the Fed's shooting for.
Yeah, and there was I don't know if there's a question or comment, but I'll read it because it came in and it's topical. So I'll read it off. The supply demand curve is a traditional factor driving inflation. However, much of the current inflation is the result of corporations noting that people are continuing to buy at higher prices. No incentive to reduce price when demand is stable. So I would agree with that, and what I would say is it's a similar effect to the stock market and the housing market. When there is excess capital, when people have more money in their pockets, they're more willing to spend it. So I said this in one of our webinars, really back during COVID, and have kept saying this. It's a simple fact of too much cash chasing too few goods, and you're seeing that come out. And the problem is the wage growth is a traditional labor market force. It is not a fabricated monetary policy by some central bank that's kind of tinkering with the market. So wage growth is what's continuing to breathe life into inflation. So even as much as the Federal Reserve tries to break it, wage growth is continuing to breathe life into it. So I think that's why I say they can't say it, they can't come out and say it, but I think the Fed would welcome a higher unemployment rate.
And that's why we went so high. I mean, they actually defined, I remember sitting in my economics class in 1983, and they talked about the average unemployment rate at that point in time being 7%.
Yeah.
So, and it's, you know, it's the target is 4.
Right. So let's maybe let's be a little more optimistic, because we are investment advisors, and I always tell people I'm wired to be optimistic because I kind of have to be, right? But this is really a bright spot. So and again, this goes similar underpinning themes here, but really we're looking at 2 pieces. So corporate earnings season is looking healthy. So the chart on the left is showing quarterly earnings or annual earnings seasons, and then the green pieces are earnings recessions. So these are not actual, cyclical recessions or bear markets. They're earnings recessions, meaning corporate earnings are decreasing. And as you can see, where things are today, earnings do not appear to be in or heading into a recession. The chart on the right-hand side shows on the S&P 500, this gray line is earnings growth year to date, positive 5% across the S&P 500. The actual return, and as of this particular chart, was negative 25%, which is about where it bottomed out. That was the drawdown on the S&P 500. So what this basically tells you is most of the negative, the downside is multiple compression. In other words, investors aren't willing to pay as expensive a price for companies, right? The excess speculation is being sucked out of the market because investors are realizing that with the Federal Reserve raising rates and the quote unquote liquidity tide going out, well, companies like, your high flying tech companies that like to innovate, well, they need a lot of capital to do that. So that excess speculation where you're willing to pay a high price for a company that's trading on those expectations, well, that's going out the window. So while earnings has kind of held up the S&P a little bit, that multiple compression has driven it down. However, for moving forward, earnings appear to be a bright spot, which is good news, because a earnings-led recession, in other words, one where corporate America is having a hard time making ends meet, that's typically a lot more painful.
So let's expand on that a little bit, because you and I were talking earlier about this, and interest rates have a lot to do with reinvestment, capital investment back into the economy. And when you're talking multiples being too high, a lot of that comes with our growth stocks, our tech stocks, and that's actually reflecting over the last couple of days. We had Microsoft come out and miss earnings. We had I think Amazon just came out and missed, and they're down about 20% right now. Almost 30%. And, you're going to see most of those tech stocks starting to miss, but where you do see earnings hitting, and you can see this actually reflecting in the Dow Jones versus the NASDAQ. The Dow Jones is continuing to move up because we have a positive we have good cash flows in a lot of the stocks that are within the Dow Jones. Actually, Meta missed again today too. So Meta was down quite a bit, Facebook. But you'll see that reflect in the tech stocks more that are highly leveraged companies versus high cash flow companies.
Right. Exactly. Yeah, exactly. Yeah, all those companies that, again, they're trading on speculation, trading on expectations, need capital to innovate, need capital to grow. enjoyed a major run up, right? While capital was easy to get, but now that the tide is turning, we're seeing a sell off. So, but I think that moving forward, though, earnings actually paint a bright picture, even though for some of those growth stocks, it may not be quite as bright. And in aggregate, it's a good thing. The other thing I would point out too is just some perspective on bear market corrections and what comes next. These are returns of the S&P 500 after a 20% fall from a record high. So essentially after a bear market. And this is showing you examples going back to the 50s. And what this chart is showing is after 6 months, after 1 year, after 2 years, after 3 years, where the market is. And 9 times out of 10, so we're not to the 3-year mark from the 2020 correction yet, but 9 times out of 10 after 3 years, it's positive again. Okay, 7 times out of 10 after a year, it's positive again. Okay, so we've had a 20% fall from the record high earlier this year. So that was, from that 2020 number, right? We didn't get to the end of that 3 years. There's another one in this mix now, which was, I believe the market hit its high actually right at the end of last year or the beginning of this year.
It was the end of last year. The market was mid-November, I think the market hit.
Yeah, I thought it was mid-December. But anyway, we're talking about the same thing. So point is that we're well into it. We're past 6 months. We're still negative. Typically, within 1 to 3 years, you're back positive again from that previous high.
Yeah.
Okay, that's
kind of. And point out just 3 of these time frames here: 73, 2001, and 2008. I was in the market for 2 out of the 3, but 1973. It was just a bunch of supply shocks after they took us off the gold standard, and that caused just a series of downward spiraling markets throughout the 70s. A lot of volatility, kind of like where we are today. 2001, actually, that whole downward market started out with a tech wreck in March of 2000. Right. And then we continued in that 2001 after the World Trade Center, which Greenspan actually responded to that right away when the World Trade Center got hit. And then we 2001 we were down -7 by March, and then by the end of that 2001, I think we were probably more positive, and then 2002. We went down quite aggressively again, and it just made for 3 years, almost 3 years of flat markets, as you were talking earlier, Dan. Doesn't necessarily mean we're going to be flat next year. I think you got another slide that talks about that. But 2008 was just a different animal all across the board because of the leverage we had in the housing market. And how they were putting the bonds together and how they were identifying things. It caused just a banking collapse in 2008. So that, I think we're going to have something similar to the volatility where we come out of this 2 to 3 years later and we have low single-digit returns. Just to give you a thought process and what can come out of this. So it is going to be interesting.
And I think there's actually some reason to believe that there can be a lot, like with the volatility, you got to take the good with the bad. And I think there's reason to believe that we could see a lot of upside. And then, we could also see a lot of downside. You mentioned, the World Trade Center, right? Like there are geopolitical things going on nobody can predict. You know, I mean, you couldn't have predicted the, I mean, now maybe somebody, you know, some insider could have, but, you know, you couldn't have predicted that Russia would invade Ukraine, right? You know, we don't know, you know, Russia lobs a nuke into the Eurozone, or China
Can't
invades
predict that.
Taiwan. Nobody can predict that, right? But, and that would obviously throw markets into a tailspin. So, you know, you have things, or you have another Liz Truss who decides that, you know, she's going to cut taxes while inflation is running rampant, and then resigns as PM of Great Britain. I mean, these things just like, that's just, you know, and then not 2 weeks later, you know, the ECB just raised rates by 75 bips. So it's like you got all these like violent policy moves going on by people in positions of power who seem to have, you know, absolutely no grasp on, you know, what the consequences are. You can't, these are things you can't predict. And they really do with the global economy. These are interconnected pieces that really do have an impact. You know, one of the major impacts of what the Fed has done fighting the inflation on the home front is they've really failed to appreciate what they've done to the strength of the dollar and how that impacts American manufacturing and, you know,
Overseas.
Right, exactly. So I think that, you know, there's always a push and a pull, and you have to appreciate, you know, kind of both sides of the coin. But I think a lot of these things are unpredictable because you never know, you know, you never know what could happen during these timeframes. And 2001 is probably a great example of, you know, you had the World Trade Center, and then you had the tech kind of .com, you know, pop, right?
Tech wreck.
So
it's 5 of. Let's go on to that next slide and show a little bit more positivity
yeah.
about what potentially could be next year.
So one positive, like cyclical sort of calendar year tailwind is midterm elections, especially if the Republicans take the House, because and I had another chart, but I couldn't find it before our webinar here. But typically, when there's a divided government, the market really likes it because then you can maintain status quo, and they can't hurt you too much if they can't get anything done. So typically the market likes a divided government, but generally speaking, midterms have been a good buying point, quote unquote. So this is going back to the 50s. Every single year after a midterm election, this is just using the election date as the starting point and going 1 year out. Every single year going back to the 50s has been positive. And like in a big way, because compared to non-midterm election years, it's 8% higher on average than non-midterm election years. So I think this is just, again, from a cyclical and from a sort of calendar standpoint, this tends to be a inflection point for markets. And then lastly, I think this is just sort of big picture, you know, something to think about whenever you get a recovery, whether it's from a bear market, recession, you know, whatever, however you want to define it. A lot of the returns, a lot of the recovery is front loaded, meaning a lot of those big swings happen at the bottom, happen at capitulation, to call it back to what Rick, what you said earlier. And this, I love this chart. This is going, this is a 10-year time frame. This is 09 to the end of 19. So there's multiple different versions of this, but it always shows the same picture over a long period of time. And that is, if you take your original investment, right, there's your $1,000 original investment. And if you were to just, and this is just, again, using the S&P 500, you stay invested the entire period, that's where you are at the end. And this is, I think this is probably the most impactful. If you miss only the best 10 trading days, only the best 10 over that entire 10-year span of this chart, you are losing out on an incredibly large amount of returns. You only miss the best 10 trading days. So we're literally talking 2 weeks out of the market. And you missed most of the returns. In fact, that on that $1,000 original investment, if you miss somewhere between the best 20 to 30 days, so call it 25 days, so you missed the best month of trading, you didn't make anything. And to time that is incredibly difficult, almost impossible, right? And at a certain point, you actually end up losing money if you miss the best days. So this is really just this is, to go back to what I said initially, it's more about time in the markets, not timing the markets.
Right. And that doesn't mean we're not doing anything while we're sitting there and we're telling you to stay put. We might be sidestepping, taking some tax losses and things along the way, because there is opportunity in every single market, whether it be up or whether it be down. So when it's down, there's a lot of opportunity to do some tax loss harvesting and kind of push that forward for the next couple of years, so we can reduce ultimately taxes in the years to come, or reduce taxes on people that are selling their shore houses or selling their homes and moving into other areas and paying capital gains, selling their businesses, which has happened quite a bit over the last year or two. But Dan, I think we answered many of the questions along the way as we were walking through this. So,
yeah, if anybody has anything else, feel free to pop it in the question box. But yeah, I do, and I agree, Rick, and we've been talking about it a lot. Is harvesting losses a good idea, but certainly not from a timing perspective, right? Stay invested and just swap out. It's certainly opportunistic when the market is down. So,
and the other thing is sometimes we might get a little bit more conservative in maybe moving out of some of the more volatile stocks into some of the less volatile stocks as we're walking through this and trying to squeeze some move out of the volatility. So, but Dan, I appreciate you putting all that together. That was some really good insight, and I'm looking forward to the next quarter. And more importantly, I'm looking forward to what's going to happen after the election, because I'm looking forward to an up market. I am never in a bad mood, Dan. You know me for 10 years. You give me no sun, rain, and a bad market, and I can be in a bad mood easily.
Yeah, well, that's very true. That's very true. But like I said, I'm always optimistic. So the good thing about a down market is there's got to be better days ahead.
Absolutely. Just a matter of when. So
it's just a matter of when. So, all right, everyone. All right. Well, thanks for joining us today. If there's anything else, any questions you have, you want to talk about directly, just reach out, let us know. And thank you for joining. And we'll see you next quarter, if not before then.
Take care.